What is up, Bitcoiners? Welcome to another episode of the Bitcoin Magazine podcast. I am sitting here with my man, Dylan LeClair, BTCization. We had a great conversation with David Puell, one of the OG on-chain analysts, and in my opinion, one of the best analysts in the space. Dylan, this was your first time getting to meet him, and you had some great questions. What was your thoughts on the conversation?
Yeah, it was really interesting. A guy with a lot of market experience, traded through a cycle or two, has a really deep understanding of derivatives and just the inner workings of these markets. So it was awesome to sit here and pick his brain a little bit.
Yeah, dude. Well, again, you were asking some really complex questions. And for the listeners out there who are faint of heart, guys, this podcast, we go deep. We go deep on finance. We go deep on markets. We talk about all these insane market forces that are kind of circling around Bitcoin. So you might have to listen to this one once or twice. You might have to look up some lingo and words that are being thrown around. But awesome. Honestly, this is a really, really awesome conversation, and there is a lot of alpha in here. So if you can pick it apart, there's definitely some sats to be stacked. But until then, let's talk about this podcast. Let's talk about this podcast sponsor, which is Bitcoin 2021. This is the biggest conference in Bitcoin history. It's the biggest event in Miami, in Florida, since the Super Bowl. So, this is a really big deal. The mayor of Miami is going to be greeting the Bitcoiners into the city day one of the conference. And we have Michael Saylor, we have Jeff Booth, we have Preston Pish, we have Cynthia Lummis. These are just one of just a few names of our incredible speaker lineup. Go over to the site, b.tc/conference. Go check out all the speakers. Go get yourself a ticket if you haven't gotten one already. I feel bad for you. I'm sorry. They're pretty freaking expensive at this point, but you are waiting to the last minute. This is your own fault. It's all about personal responsibility. And you could have got this ticket at one point for $200. Now it's $900 if you pay with BTC and north of $1,300 if you pay with fiat. And honestly, don't pay with fiat. Don't do it, because we have a partnership with MoonPay. And MoonPay, you can use your debit card, Apple Pay, Google Pay, your credit card, whatever, to buy Bitcoin and pay us directly from our ticket page in Bitcoin. So you don't ever have to pay in fiat, or you can pay in fiat and we can get paid in Bitcoin, and no one has to know the difference. You get the discount. So check out MoonPay. They are one of the coolest apps and builders in the space. They build out payment infrastructure. They are in 160 countries and over 300 wallets. So what does that mean to have MoonPay in your wallet? So instead of going to Coinbase and buying Bitcoin in Coinbase and then having to withdraw, you buy it using Apple Pay through your non-custodial wallet on your phone. Apple MoonPay, charges your debit card and then sends you Bitcoin, sends you sats to your non-custodial wallet off the bat. It just completely bypasses the custodial aspect of buying Bitcoin with fiat. It's pretty freaking cool. And they are building this infrastructure into tons of different wallets and tons of different services, just like our website over at b.tc/conference. So go to b.tc/conference, go click on tickets, go check out MoonPay, learn more about them, figure out how you can leverage MoonPay to get your Bitcoin in a non-custodial fashion, and meet their team as well as our team at the conference. Holy shit, that was a long freaking ad read. Thanks for sitting through that one, Dylan. And let's get into this podcast with David Puell. Bitcoiners, I am here with another episode of the Bitcoin Magazine podcast, and I'm joined by my co-host, Dylan LeClair from our Bitcoin Magazine content team, and we are sitting across from world famous Bitcoin on-chain analyst and pioneer really in the on-chain space, David Puell. Welcome to the first time on the Bitcoin Magazine podcast, but welcome back to Bitcoin Magazine.
Oh, pleasure, man. Thanks for having me.
So, David, I guess since it is your first time on this podcast, why don't we start with a kind of brief introduction on, you as a trader and you kind of pioneering in the on-chain analytics space?
Well, I guess my main influence into, tackling on-chain economics, Bitcoin, was Willy Woo. I guess like most people here have that influence, people in the space. So I began tackling Bitcoin in like full time in 2017, mostly as a trader, um, mostly on a shorter term basis, despite being a long term believer and all that stuff. But starting dabbling into on chain in 2018, and what happened was we saw the publication or the announcement, you could say, of Realize Cap in the Riga conference in 2018. I think it was September, October. And Murad Mahmoudov and I devised one of the classic on-chain metrics today, which is the MVRV ratio. It's a simple ratio dividing market capitalization by realized capitalization. It picked up, and we met Willie, and I continued to just collaborate a lot with him, and that's when a bunch of new on-chain metrics came about, either with him or independently. And that's pretty much has been my focus for the most part, that and just trading the asset. And here we are. That's the gist of it, I think.
Yeah, I think there's a lot more to it than that. But for all the listeners who want to learn more, David's done a ton of amazing podcasts and panels out there. So just look him up online, and you can learn a lot more about his deep kind of trading and on-chain history. But let's jump into these questions, right? So I think that the market right now is truly in a state of confusion, at least for many Bitcoiners. They're kind of looking around. In 2021 has been a lot of frenzy in the altcoin space. Yes, Bitcoin has done quite a bit, but it has been outperformed. And people are kind of looking around like, what the hell is going on? So, I guess, want to just put you right on the spot, but, what's your kind of assessment of what's happening in the current state of the Bitcoin market?
Well, I think it's like the modus operandi of bull markets in crypto. You saw the same phenomena in 2017 mostly, where you have a lot of capital rotating from Bitcoin to alts once Bitcoin has consolidated the uptrend for everyone to see. I think it has today. Back then, it has had to do a lot with the ICO boom, retail going into those assets, etc. Right now, I think it has to do a lot of rotation, but a little bit different in the sense that yes, retail or some OGs and retail people that stayed for the bear market are now transitioning into altcoins to capture more alpha and upside, especially because they didn't pump that much in 2020, right? And you also see institutional interest in other crypto assets, right? You have to give you a very obvious example, you have the Roll Pauls of the world, first dabbling and obsessing over Bitcoin, and then just going into Ethereum or whatever altcoin. The DeFi space is also very, very, not just Bitcoin, but DeFi in general is being, severely hyped, whether it's overhyped or not, at the very least hyped, you could say that's a fact. The NFTs, so it's propping up a lot of different asset classes within the crypto space into the mainstream, right? It's not only leaking into Main Street as investors, but mainstream as part of the culture right now. So you're starting to see the Bitcoin flex, the NFT flex, everyone from chess players to artists, tokenizing everything, maximizing gains via that mechanism. I think it's just like a regular part of any crypto bull market, up to the point where the industry becomes diverse enough and tested stress tested enough so that you assess each asset individually. I do think at this point that Ethereum has a lot of Lindy effect. It has survived a lot by now, whether it's centralized or decentralized, and the assets built on top of it are safe or riskless investments. That's another matter, but as of now, most people feel comfortable investing in it, especially as potential outperformer of Bitcoin in bull markets, right? A completely different question in bear markets because crypto is very reflective, price reflective. So the downside with altcoins is much more painful. But even from a measurable, like a technical standpoint, you saw that the same decoupling in terms of correlation between, let's say, Bitcoin and Ethereum exactly in Q2 and Q4 2017, right? So now we're in Q2. We're noticing that same correlation where like sometimes, especially on the intraday time frames, you see Bitcoin at oversold while Ethereum is overbought, right? Stuff like that. Like you notice that sort of decoupling. It's good for diversification, especially if you're like a crypto-only hedge fund or crypto-only trader or holder, right? But goes with the risk that you better catch the top not to get wrecked completely in the bear market. So let's see what happens. So far is normal, and that same rotational spirit that we had in 2017, I think it's just capturing institutional behavior as well in the cycle. It's just like different scales and different investing personalities, you could say, but for the most part, it's the same thing.
Like, how closely would you say 2021, based on what you're looking at, resembles 2017? Like, obviously the narratives are different, but like in terms of like what you're looking at.
Well, yeah, from let's say evaluation perspective, so far, it's atypical, like every bull market. Not history rhymes, but does not exactly repeat itself. So you're right now you have the two main possibilities that we're building a major top, and then a huge correction is going to happen. This is like the double bubble scenario where you have the huge correction in April 2013, right? To give you an example, and then that correction build up the second part of the bull market into the top in November. We can see that for sure. That would be my most bearish scenario as of now. Or you could just see it continue to pump, especially after the last few months where we've been like consolidating for a while now in the same range, right? Between, let's say, 40 and 60 or so. So if we have a breakout, that's correction enough in terms of time so that we can like actually pump to the meme prices of 100 to 150k, whatever, right? Which with a much healthier history, you could say, right? Because just pumping without any correction on price or time, it's unhealthy. So it's good at the very least that we've seen a consolidation, and it's taken a while. It's very healthy.
David, I have a question for you. So when looking at previous cycles, and you have many different like valuations and metrics to look at, what do you think the effect of the kind of a developed, I guess, physically settled derivatives and futures market has on this cycle, and about like the valuations that come with it? CME came at like the 2017 top with a futures market, but it was cash settled. Now there's mostly offshore. There's not many. There's no exchanges in America, derivative or futures exchanges. But like, how do you think that has an effect on market structure?
I think it has a deeper effect, but even even if that's the case, I think it has mostly an effect on an intradaily basis, meaning the wicks, the famous wicks and shakeouts and liquidation events, than, any narrative that, derivative markets are driving price in some fashion. I generally don't adhere to that reasoning. Even in 2018, which is the heyday of the derivatives market, especially compared to spot volumes and and when you compare BitMEX, Binance volumes with Coinbase and all the oracles that are the basis for all these contracts. You saw all the major price movements in Bitcoin could be explained by very precise fundamental reasons that affected spot more than derivatives, right? So if you go back to the history, like if you go back to, let's say, 2018, 2019, you had the collapse of the ICO boom, right? Coming off severe irrational exuberance in late 2017 and early 2018. Huge consolidation, the hash wars producing a huge capitulation event to 3K. Then that marked the absolute generational bottom. Then you had the plus token era, right? Where you had a lot of supply restriction. 1% of the supply was being captured into a Ponzi scheme. Restricted supply, prices drove up completely, despite the fact that there wasn't that much new money on it. You had like artificial buying via the Ponzi scheme. And then when the Ponzi scheme, got busted by the CCP, and the CCP started unloading those assets in the middle of 2019, you had another major correction, right? Over 200,000 Bitcoins, of course, is going to have like a longer term or at least intra-yearly impact on price. Then that distribution wore off when we were back at 6K. We were out of the water a little bit, and then the major black swan of COVID came and collapsed the market back to 5K. So you can pretty much track the history. Everything is spot driven. Everything is, you can explain it first principles from very fundamental reasons on why price fluctuated that way. And derivative markets were only affecting price on a week intradaily basis, not on a fundamental valuation basis. As soon as we had new money coming in, the Paul Tudor Jones and etc., after the COVID collapse, volumes on spot were much better relative to derivatives, and you can actually see a bull market driven by just people buying, and you see the results now. It's pretty much a year without a major correction, over 30% or so.
Yeah, I feel like the market is very healthy right now, and as frustrating as it is for Bitcoiners to not see number go up constantly, $1,000 a day and stuff like that. It is healthy to have this kind of consolidation. And I just wanted to comment that every time I've spoken to you, David, it always blows my mind how you can just recall historical events and the Bitcoin price and the Bitcoin chart all at the same time, just off the top of your head. I feel like you may have memorized the entire Bitcoin chart history. So I think that's just a testament at how much you look at the chart.
Yeah, that's basically, it's nothing. I'm not a scholar on it. I just look at it all day. Then just some things stick to you. That's the secret. You just stare at the charts all day.
So I have another question, kind of bouncing off that second one. So with a developed derivatives market coming in and open interest on options and futures, I mean, it's still pretty insignificant, around 30, 35 billion. And a lot of, I guess, institutions coming in to arb this spread with the cash and carry trade. Do you see that as maybe a driver of spot volume, or at least institutions coming in to to execute this trade actually, have to buy the underlying spot Bitcoin. So is this maybe a driver of capital as, credit markets in the legacy financial world are offering really no yield?
Well, I do think it's like it makes the whole ecosystem more robust, especially for smart traders, you could say, or smart active managers, in the sense that you now have more platforms to onboard your hedges or your arbitrage or whatever trading mechanism you're using to de-risk your trade, especially because Bitcoin is seen as a very risky asset. Or at the very least, you can claim the fact that it's volatile, right? So with that trade-off of the asset, the more platforms and instruments that you have to the risk your active management, it's as a secondary, you could say, externality. You could see like more smart traders going into the asset from a spot perspective, because they have the other instruments to risk their trade, right?
Yeah, so be market neutral.
Yeah, exactly. And especially if those platforms are not offshore, are regulated, are robust, are highly accountable from a regulatory perspective and all that, right? So I just think it's a plus. Now, what we saw in 2017 was very particular, was because, we already had caught up with reaction and exuberance. No smart institutional money was buying. All the crypto hedge funds had already, bought what they bought, like either, in 2016, early 2017, and then the laggards, late 2018. But, the whole market was at a peak irrational exuberance, completely disproportional to adoption. And, so yes, you had the launch of the CME and CBOE derivative instruments, which was the perfect opportunity to short, right, at that stage. So at those prices, given that weeks prior you had 2x increases in price, it was just a better trade, the uncrowded trade, and it made much more sense to it. But now that you're actually seeing Bitcoin and crypto in general, branching out not only into Main Street, but completely into the culture, right? Both in Asia and the West, it's more nuanced, you could say, right? So any new platform or any Lindsay Lohan tweet, yes, it's a sign of some exuberance, but you have to consider your position much more in a much more nuanced way, because it's all about proportion, right?
Yeah, and so personally, I completely agree and align with you. I feel like you see this coming, you understand why the clowniness has to happen, and we haven't even talked about like how what's happening in the traditional world is completely and utterly clowny with all the COVID stimulus from an assets valuations perspective. So like we're not even talking about that and how that actually affects crypto prices. But like I feel like there's so many Bitcoiners out there who are looking around like this is the top. Like here's the craziness that we expect, right? And like no, you need to expect 100 times more than this. You need to expect just complete and total insanity compared to 2017. And I feel like you align with that.
Yeah, it's much more, well, that's what makes trading bubbles hard, right? Because I mean, maybe you're in a bubble, but it's a whole different story to get the top, right? Exit at the top, after losing potentially 2x, 3x gains at the very end of it, right? So right now, it's very obvious that you have much more fundamental reasons to not get scared by Magnus Carlsen doing NFTs on his chess games, or how whatever pop star shitting whatever shitcoin, or whatever. It's much harder. That's the hard thing about bubbles, detecting tops, because it's all proportional. So you never know what's enough until you know what's more than enough. That's a William Blake quote that I think applies to markets very nicely.
Yeah, that there's a lot of wisdom there. So, I mean, I guess talking about Bitcoin seeping into the culture, like there's always this narrative these days around the super cycle. I feel like Bitcoin Tina and I really push this hard with our podcast, The Hardest Trade, where we talk about, the potential for people to get wrecked because they're looking for a blow off top and then a massive decline that never happens, and they just end up having less Bitcoin. And we talk about different scenarios in which that can kind of happen, and discuss what we think is the hardest trade in general. But I guess would love to post that to you. Like, what do you think of the super cycle narrative and Bitcoin and crypto just becoming part of the narrative, becoming a bigger part of society in general, and maybe like less speculative?
Yeah, I think it's going to happen, but I think we're at least a decade away from that, in the sense of what you mean, like less speculative. I think speculation is going to be going and going for years to come. That's just the fact of the volatility of it. It's all relative to the volatility. So until we get to a point where volatility is quite enough, and that becomes, we get to that point where it's actually more a medium of exchange than a store of value in terms of narrative and actual usage. Then we have that. Okay, it's more like to actually pay for stuff, right? Save my money instead of just becoming a big trade for whatever holder. So for that, I do think we're a few years away. The super cycle. Well, a few things would have to happen for that, hypothesis to play out, which keeps me a little bit skeptical or a little bit wary in terms of that. And it all depends on how price rises, right? If it goes up in a very unhealthy way, you're for sure going to have the typical feedback loop of irrational exuberance, right? Weaker hands coming in, wanting cheap money, more incentives to profit take, both from the retail guy and the OGs as well, that are perhaps in this from 2014 or whatever or before, and institutions as well, right? Like institutions, especially institutions, they evaluate each asset on their narrative, sure, but they change opinions. That's one. And even if that they have like a long-term opinion on a certain asset, they may not hold it on an inter-yearly basis, right? So if they actually look at the macro stuff and say, okay, things are not as inflationary, right? And so they don't have any, much more incentives to drive capital, dirty USD into asset prices, right? Including Bitcoin. They may decide to use profit take. You also see the incentives of a lot of institutions, including, Guggenheim and a few others, that, they see a 2x return, after buying a 20K, they sell at 40, at least partially, stuff like that, right? Because, they don't want to like shit the bed so severely. I do see a lot of factors that incentivize selling, especially if price just pumps like crazy. The only way I may go into a super cycle theory from a technical perspective, just looking at the charts, because, a lot of fundamental driven events, you cannot calculate them. You can see trends, but, major swans in the market, you cannot like predict them so far in advance. But perhaps if we go into price behavior where you have severe moments of consolidation like we're having right now, let's say price pumps for 6 months and then consolidates for 6 months, that would be healthy enough to drive a super high cycle, right? If it gets volatile, I do expect a major correction. That's just the nature of markets and humans and all that. You know, whether it's an institution or Katy Perry.
For you yourself, this cycle, taking a look at the markets, if we see somewhat of a repeat of 2017, where there's kind of this super volatile blow off top, what sort of strategies would you think about employing, to, I guess, time the top? I mean, obviously, there's the option of selling spot, but would you look into hedging by selling futures or, selling covered calls or, how are you thinking about that?
I mean, yes, you have all those options. Personally, I'm not going to disclose my
That's fair.
my what to do at the top plan because for several reasons. But I guess it depends on the personality of the holder, in the sense that one, there's some sophistication required to hold those assets, right? Even more so with options. So it may be just easier for someone to maybe not sell all, but take some profits, right? Like recover your initial profits, strategies, simple strategies like that, or every 10K I sell 5% sort of stuff, right? Very simple stuff. That may be like sounder because you remain as a holder, but and that's a healthy aspect of a market, that if you actually sell some and you see lower prices after, right? You have some dry power to deploy and build new bottoms, right? So that's healthy, right? And it's healthy for Bitcoin. So not selling ever. Well, if you're a long-term believer, right, you should be the actual person who has some cash to deploy at the bottom, right? You're literally the guy looking for it. I think a little bit of that is what happened in 2018, 19. You had absolutely no new money, and most of the money that remained were just holders, like hardcore holders, right? You saw it on chain, right? Like Coinbase destroyed, dormancy, all that stuff completely collapsed, but prices, still went down a little bit more. You saw a very healthy lack of destruction and just coins moving around when we were at 6K in middle of 2018. But then, hash wars came along. There was no new money that was strong enough to hold that, and we just dropped to 3K, right? So a lot of that stuff, I think that's one of the reasons Bitcoin goes into very, binary market cycles. Whether you actually know you're in a bull or a bear cycle, right? Like after a few months of the bottom or the top, you actually know, oh, I think we're in a bull market. I think because it's just the property of the asset. You have very long-term holders that perhaps never sell, or sell when you have like a full-blown bull market. And then you have to wait for new money, for whatever reason, right? Whether it's just retail exploding or COVID and stimulus coming in and incentivizing a lot of pulling cash into asset prices in general. That being Bitcoin the most momentum driven, you could say.
I think that makes a lot of sense. And I mean, ultimately, it's the fact that there is so much new money as a percentage of the population, and there's so much new dependent on new money entering the space for valuations to go up, that I feel like this is why we kind of have the altcoin aspect of the market. Like, there needs to be a vessel for alpha on Bitcoin. There needs to be a way for people who have opposing worldviews to express themselves in the cryptocurrency market. There needs to be all of these kind of like aspects, and the market is delivering, right? There is just demand for it, and the market is delivering it. And I mean, again, as a Bitcoiner, I'm at Zen with that, because I see that as making Bitcoin better. I think it really does make the Bitcoin market better. And I think all roads lead to 21 million personally. That's my thesis here.
21 million in what sense? In price?
Like 21 million Bitcoin, as in like all the value will end up being denominated in 21 million Bitcoin.
Oh, okay, got it. Yeah, I think it's just part of, and also like having, perhaps you don't agree that, you know, crypto has a lot of optionality, just having the sense of it and letting newcomers learn their lessons on what's valuable and what's not. I think it's very healthy for any, you know, up and coming industry. So I don't mind, you know, people buying whatever they want. I just don't care. I just, you know, take care of my own portfolio. People can take the risks they want.
Yeah, I have a couple questions. So what do you think about the lag in hash rate? Since the halving, price is up more than 600%, and hash rate's really lagged behind. And hash rate and the miner difficulty continuing to increase after the blow up top was one of the reasons for that major capitulation. If there is still this significant lag and miner profit margins continue to increase, do you think that, you know, how do you think that plays out and has an effect on markets, if any at all?
I've always steered that hash rate follows price, and maybe, and sometimes not even that. Like, I do think that miners are, especially, you know, the bigger, smarter miners in the world, have resources enough to be profitable on a monthly, let's say, basis, irrespective of what's going on with the price. I think that you could call a divergence between, you know, price increasing much more in proportion to hash rate in the bull market, just in the bull market. I think it's natural because you have completely the opposite in the bear markets, where, you know, hash rate keeps pumping, difficulty keeps increasing irrespective of price. I just think it has to do more with the floor of being profitable, that the trend of price itself, right? So whenever you have a cost basis for miners, price fluctuations are not that important, because if you break even, you just don't care. If it's profitable, you really don't care. The other thing, yes, like miners have less impact in the price of Bitcoin now as natural sellers, of course, and that's going to continue for, you know, as long as the monetary policy of Bitcoin, you know, is not changed. In terms of, there's a few signals on chain, like the hash rate ribbons and a few others, you know, that mark whenever, you know, miners are at a relative loss, you could say, for days, perhaps to weeks. You saw that on the China shortage we just had a few weeks ago. You know, miners were below that price floor. That tends to be a good indication of, you know, general capitulation in the market, because that floor seems to be very important in terms of fundamentals and also, you know, speculative gauge. But for the most part, I always adhere that hash rate follows price. I think it's a lagging indicator, a very good one to that. But as long as you keep having a decent increase in hash rate relative to more to its past than to price, I think the network is secure enough, and you know, the fundamentals of Bitcoin in that respect remain strong. So apart from that, I do not think that it leads price in any way, shape, or form, especially now that miners are less important in terms of price, actually.
Got it. So, I mean, I think kind of going off of that, do you think that because of the decreasing block subsidy, that the halving is not as significant as it once was? You know, like the stock to flow model. Are you more in the camp of that this bull market is from the monetary stimulus and the macro backdrop rather than the halving? Or, I mean, I think obviously it's a little bit of both, but what are your thoughts there?
Yeah, I a little bit of both, but I do think it's more the macro stuff driving the whole thing. I do think that it holds a very strong speculative meaning for investors. The fact that we're just having the supply by half, the emission of supply. But I'm not sure it's meaningful enough to get that much new money into the ecosystem, right? Let's say if we wouldn't have had the COVID panic and all the inflationary hedge panic in early middle 2020, it's a good question if Bitcoin would have pumped so much, right? If pretty much Paul Tudor Jones would have gotten into the space and pretty much single-handedly legitimized the asset for Wall Street, and let alone Wall Street, but also SF and all the big techs in the world, not just New York but also San Francisco. So it's very hard to gauge what would have happened. Stock to flow, I mean, it's good as a meme, and it has good rationale behind it in terms of, you have a very calculable and definite supply system. But I've always held, and I know Bitcoin Tina is gonna text me right after he listens to this podcast. I'm sure of it. I do hold that it assumes a somewhat linear or increasing demand for it to play out, which may happen, right? But the assumption from first principles that you're making is, okay, yes, the main value of Bitcoin is that it's scarce and that it's very difficult to change that monetary policy, right? Those are like literally the two main drivers of its demand, right? But you have a lot of, little swans in the eco and in the world in general, in the world economy that may prevent the meaning of that to become actual skin in the games from new money and other from retail institutions, right? So unless you don't have that, the incentives for demand, the fact that your asset it's scarce is not enough. It's a huge driver for sure, but in my opinion, it's just not enough. You do need the counterpart. Price is supply and demand. It's not just supply, but it's a good meme. If it works, that's perfect because it's giving insane valuations over time. I have no problem with it. I just don't trade that much around it. You shouldn't do that with any model, right? I just keep track of it maybe once a week. That's about it.
I don't want you to spill your special sauce, but I am kind of curious about indicators that you do find tradable, right? That you do actually rely on and like.
On chain or in general?
I would be curious about both, like, all and above. But yeah, I mean, I'm sure everyone is curious about your on-chain preferences too.
Well, depends a lot on what you're doing, whether you're a, let's say, long-term or short-term active manager / speculator. If you're long-term, just look at the usuals, the Puell multiples, MVRV ratios, the HODL ratio, our HODL ratio, the one that Philip Swift created. A bunch of that stuff can give you information of, just having a sense of, okay, are we at the top or not, right? Should I be the profit taking or hedging a little bit here, long term or not? And then to maybe have some additional alpha, I'll mention very few very public ones. You can go with the SOPR created by Renato Shirakashi. That's a very good indicator. There's several versions of it in Glassnode. I'm not sure if in Coinmetrics as well. They have it in Coinmetrics, but just one version. But in any case, it's a good way to determine, okay, I'm under the assumption of this is a bull market, let's say. So whenever you go back to one in terms of spend output profit taking, that's a good way to detect the bottom, right? And vice versa. The only thing is that it doesn't give you the absolute top, the generational top, you could say, or the cycle top. It just gives you the dips along the bull market or the tops along the bear market, more or less, for the most part. That's a good one. And I think the most widely used indicator, especially among shorter term traders, is funding rates and derivative premium. Nothing to do with on-chain. It has to do with the delta between price and the derivative exchange, let's say BitMEX, and spot price. The oracle of in BitMEX. That weighted average between Coinbase, Bitstamp, and all that stuff. Generally, if you have negative funding rates, it's bullish, and positive funding or a premium, it's bearish. I do think that a lot of market behavior gets encompassed in that indicator, irrespective of the open interest or the volumes traded. So that if you have more demand for spot, Bitcoin itself as opposed to its contracts, it's a very bullish sign. So that's when you have spot under derivative, meaning a discount in spot. So it's cheaper to actually buy the asset than the contract, right? By a slight margin. That just means that it's more demand on spot, and it's very healthy, right? And it means that the long trade is not overcrowded as well, right? You always want to be on the other side of the crowd in the majority markets. So for the most part, it's a very useful indicator. It also has to be nuanced in how you trade it and assess it, especially in a bull market, because the premiums of derivatives go crazy, go insane when price starts pumping. But you could say, either a discount in the perpetual contracts or backwardation. Those are very good signs that, underlying demand for spot is going well.
What do you expect, or like if we see this, super volatile, maybe a blow off top, what do you expect to see with these contango yields? Like maybe a month ago, these annualized 3-month rolling yields are at 35%, some up to 40 on some exchanges. With the recent dip, they're around 20%. What do you expect as, if we see a kind of somewhat of a repeat of 2017, and there's a blow off top and volatility really spikes, what happens to these yields, and what happens as all the leverage gets washed out?
That's a good question. Like knowing what contango level is actually like a top diagnostic, it's hard to get. Especially because you didn't have such a robust derivative markets at the 2017 top, so there's no history of it. Of course, the higher we go in contango, the more bearish the whole ecosystem is, right? And the closer we are to basis or actual backwardation, the more bullish it is. Long term, contango backwardation for Bitcoin, in my experience, it's hard to determine the overall primary trend. It's very good to, let's say, catch tops and bottoms when prices, fluctuating like it did in 2018 and 19. But let me give you an example. In 2018, right, we had huge contango and huge premium in the perpetual at the top. the market was not robust, so you had huge premium. Bid mix was not liquid enough, so you didn't care that much. As soon as it started, gaining some equilibrium and robustness in the derivatives market, especially in the offshore platforms, um, you had a sustained period of backwardation all throughout. Every time we touched, let's say, 6K in the first half of 2018, right? Which is the huge descending triangle after the top, right? Before the hash wars and the collapse to 3K. Then right at the apex of that triangle, when volatility was extremely low, you have the incentives to sell from miners, and the whole hash where like the fundamental event occurred, and that's when premium and contango spiked out of nowhere, right? So given the fact that you had extremely low volatility with very high contango, right, not even a pump in price, it was very worrisome, right? It means that you know spot was being unloaded severely, and what happens with low volatility, it trends to high volatility, you know um, soon, right? So that's exactly what happened. So you could make the claim for a bottom all throughout the first half of 2018 because backwardation was extremely healthy, meaning that there was demand for spot. But despite the fact that if you have a black or gray swan happening in the market and taking out your increasing the yield, but as a which in turn has the sign or the significance of denoting spot being sold and the long trade being overcrowded, then you know contango is a certain sign of bearishness. I don't know. I don't know what levels I can tell you in terms of when is going to be the top. I do know it's the crazier it gets, the more bearish I would be, and the less sustainable the market structure is. Um, but yeah, it's hard to know. But as symptoms of the market, they're definitely very useful. To give you an exact level, whether it's like 30, 40%, or I don't know. If you want irrational exuberance, like you can get it in Bitcoin. So if you go to I don't know 70, 100%, that would be perhaps a good
That'd be a good time to sell some futures.
Yeah, a little bit. Yeah, that may be a good trade in general.
I mean, can you kind of give a little bit of a backdrop of like how we even get to that point? Like maybe Dylan, you can give some color here. But I guess just like how do we get to this point where someone could just have a risk-free yield of 100% by just doing this trade?
Yeah, well, 100% may be overstating it. That's a little bit much.
Whatever crazy number, whatever you think is like a top signal number. Like, how do we get there? Like, I feel like that's like headline news at that point, right? Like in all financial markets, like it's just an insane world.
Yeah, like how does that happen? Fuck. Well,
maybe a better question is like, what breaks? What breaks when that happens?
Yeah, that's a problem, and at that stage, it becomes a problem of liquidity, right? For every contract, because the incentives to market make one side of the trade become quite complicated. But also the incentives of being in the right side of the trade make sense in the risk reward from a risk reward perspective. But fuck, how do we get there? Well, a lot of it has to do with spot. If spot keeps pumping, there's going to be more interest to hold long contracts on it. So that's going to drive the demand and exchange the contango in the derivatives, and it's going to increase the call put ratio in options, etc., etc., etc. I do think it's spot driven. Like derivative um, signs are always relative to what's happening in spot, the oracle of the contracts. So one, more adoption, but legitimate adoption, not just like weaker hands coming in, and which is usually related to irrational exuberance. And then if you actually want the blow off top, that comes from the very laggards of this whole ecosystem coming in, going all in, like the same thing that you would say at the top. Okay, if you're at a stage where you have enough people coming in that if this was the top, they would kill themselves, that's the top. Like people going all in into a single asset, shit like that, because I haven't seen that much. Or let alone that, going all in into a long, a leverage long, or some shit like that, that's for sure the top, right? I don't see enough signs of that. I think even the retail that has gotten in uh, are going in a much risk-averse fashion for the most part. Like, oh, I just put a few $1,000s, right? Not all my house and assets on it. So I do think getting to those levels, you require a lot of irrational exuberance on spot, and on top of that, on the derivative, um, creating that huge delta between them. And yeah, like I don't know, I don't want to think about it. It scares me a little.
Yeah, well, let's focus on being bullish. This is my last question, and we're gonna wrap up. But like, what's your gut feel right now? We're sitting here, 57K. It's Cinco de Mayo. We should be drinking margaritas. But what's your gut feel on price, and are you feeling bullish? And then we can wrap this one up.
Let me check. I'm checking the chart. Am I still on screen right now?
Yeah, you are on screen. If you want to share your screen, you're welcome to.
No, I'm just like trying to get like so far it looks like we had a very solid bottom of the 48 region or so. We tested the middle of the midline of the major range between 40 and 60. SOPR bottom, funding rate bottom. So you had like spot under derivative for a sustained period. Even you have some periods of that now. Price action is looking decent. I do perhaps some more consolidation. If we lose, let's say 52 or so, that's not good. Like most likely we'd go and revisit the lower end of that range, which is 45. And if that doesn't hold, perhaps 40. So let's just say remain bullish. I remain bullish in conviction as we hold 52, preferably 54, something like that. If we dump below that and doesn't look good and no new bullish signals develop from that, I would expect 45 or so at least. That's more or less my take.
Well, David, really appreciate you coming on here, chatting with us on some of these extremely nuanced market subjects and kind of things that are going down. Where can people continue to follow your work and find you?
Yeah, so I'm at Twitter and Medium, but mostly in Twitter. At Kenosha King or Kenosha King, like I've gotten both sides, but Kenosha King, which is a pun, a play on words on Kenosha Kid from Thomas Pynchon. That's the origin of my handle. But Kenosha King at Twitter, on Medium as well. I publish some stuff from time to time. I recently published a collaboration with ARK Invest and Yassine, the head crypto analyst from there. We're coming up with part 3. As an introduction of on-chain metrics is a very good primer. So check out parts 1 and 2, and perhaps in a few weeks, part 3. And and that's about it. Anything, I'll just post it on Twitter.
Amazing. Yeah. Well, we'll add that both parts in the show notes. I greatly respect Yassine as well. And I've heard great things about both series, but man, I just got so much content. I'm just always trying to consume. So it's, I definitely need to make time to jump in as well. Dylan, thank you so much for joining as well and bringing such great questions. Where can people find you?
Yeah, you can just find me on Twitter. BTCization, Bitcoinization. Just do some work for Bitcoin Magazine. So yeah, you can find me on Twitter.
I have to follow you now, brother.
There you do, yeah.
If I don't follow you already, I'm gonna after the show.
All right. Well,
yeah,
to the Bitcoin.
Appreciate your time.
Yeah, pleasure. Great interview. Thank you.
To the Bitcoiners listening, do as David is doing, go and follow my man Dylan. Go follow Kenosha King. I've been having a great time following him for the last 3 or so years, and always a pleasure interviewing you. And so thank you again for coming on, David. Again, Bitcoiners, follow us at Bitcoin Magazine. Follow me at CK_snarks, and give us those 5-star reviews. Give us those shares. It means a lot, and we're obviously spreading high quality information. I mean, like, come on, this conversation is absolutely incredible.
Yeah, I've been loving the content out of Bitcoin Magazine, by the way. Great job.
Appreciate it. That means
I saw you publish with Glassnode recently, actually, right? Like
yeah.
Basics on launch analytics as well. That's good.
Yeah, we're all about the collabs. We're all about the collabs. Right. So hey, whenever it's time for a David Puell on Bitcoin Magazine, we're all ears and excited for that.
Yeah, I'm down.
All right, cool. All right, well, hey, that's how the sausage is made, guys. That's how we make the collaborations happen. They're in real time. All right, we'll catch you later. Peace.